Capital's New Faces, Cathie Wood and Sovereign Wealth. New York, 2020-something. On the 30-something floor of a midtown tower, a small team crowds around the conference table, littered with laptops, iced coffees, and printed charts. Nobody is wearing a robe. Nobody is carrying incense. But the mood has that same quiet intensity you find in places where decisions ripple outward. On the screen, at the front of the room, a line is doing what everyone in the room both loves and fears. It is moving a lot. A growth-focused ETF is swinging up and down by double digits within weeks. The names inside it are familiar to anyone who has been near a tech headline. Electric cars, DNA sequencers, streaming services, AI chips, reusable rockets. Companies that feel like tomorrow, priced like tomorrow, and, in moments of market stress, punished like tomorrow has been delayed. At the head of the table sits a woman with glasses and a calm voice, tapping a pen against her notes as questions fly. Should they buy more? Trim the position? Hold even as the red numbers get louder? Her name is Cathie Wood. She runs ARK Invest. And for a moment in this strange decade, she becomes a symbol of something that has been building for a long time. Capital allocation as public performance. For most of modern financial history, big portfolio decisions have been made quietly, in committee rooms with thick binders, with language like strategic allocation and tracking error. If the public heard anything at all, it was a once-a-year shareholder letter written in careful sentences. Cathie Wood does some of that work too, but she does something else. She narrates. ARK publishes research openly. Its trades are visible. Its theme is consistent enough to become a story people can repeat at dinner. Disruptive innovation is underpriced. The future is arriving faster than the market thinks. And the winners, if you own them early, are not simply stocks. They are the rails of a new economy. There is a technical core under the narrative, and you can hear it if you listen. A lot of the companies ARK loves are what finance people call long-duration equities. Not because they pay coupons like bonds, but because most of their expected cash flows sit far out in the future. Their value today depends heavily on discount rates, the mathematical way markets translate future dollars into present dollars. When interest rates are low, those far-off cash flows look more valuable. When rates rise, the present value shrinks, sometimes violently. That is one reason growth portfolio can feel like they are flying in one regime and falling in another. You can explain it without equations, but the logic is pure engineering. If your company is priced mainly on what it might earn 10 or 15 years from now, then the cost of money today matters a lot. The future is sensitive to the interest rate knob. That knob is turned by central banks, inflation expectations, and bond markets, often for reasons that have nothing to do with your company's products. This is what makes the new priests interesting. They don't just pick companies. They pick a view of the world, including a view of rates, risk appetite, and how quickly technology adoption curves will bend. And because they do it in public, they turn investing into something closer to a belief system than a spreadsheet exercise. Followers don't just buy a fund. They buy a narrative about how the world will change. When markets are euphoric, this feels like prophecy. Money flows in. Headlines crown a visionary. When the regime flips and growth stocks wobble, the same conviction becomes a stress test. How much drawdown can investors stomach while holding a dream? Whatever you think of Cathie Wood's calls, she represents a shift. Some allocators are no longer anonymous caretakers behind institutional curtains. Some are brands, characters, people whose interviews and research notes can change what millions believe is possible. It's worth pausing on the wrapper itself, because this is part of the modern machinery. An ETF looks simple: a ticker, a price, a basket of holdings. You can buy it like a stock, but its magic is structural. It has a mechanism called creation and redemption that lets it expand and contract depending on demand. When investors buy an ETF aggressively, an authorized participant can deliver a basket of underlying shares to the ETF sponsor and receive new ETF shares in return. That is creation. When investors sell heavily, the reverse can happen. ETF shares are redeemed for the underlying shares. This is not just plumbing trivia. It means flows can become a force. If a thematic ETF gets popular, the creation process can push demand into the underlying stocks. If the underlying stocks are small or less liquid, that demand can move prices more than you might expect. The ETF doesn't cause a company to be good, but it can amplify the market's attention and, for a while, its price. Then, when the tide turns, the mechanism runs in reverse. Redemptions can pressure the underlying stocks. Liquidity can thin. Spreads widen. The same wrapper that made access easy can make exits crowded. This is not inherently bad. It is simply a new kind of feedback loop. And it is one reason why, in this era, narratives matter. When attention and flows align, the market can move faster than fundamentals. When attention breaks, it can move back just as fast. Now leave New York. Fly north over grey seas to a waterfront building in Oslo with a sloping glass facade. Or fly east to a gleaming tower in Abu Dhabi, Riyadh, or Singapore. Different architecture, different languages, the same quiet gravity. These are the headquarters of sovereign wealth funds, institutions that invest on behalf of entire nations. Some are built from resource wealth, oil and gas profits converted into a financial portfolio for a post-petroleum future. Others are built from trade surpluses or currency reserves, a way to turn national savings into diversified assets that can support the country later. A few are explicitly stabilizers, meant to smooth government budgets when commodity prices crash. Others are growth engines, meant to compound over generations. Inside these buildings, committees sit around long table, looking at maps and charts and risk reports, deciding how to allocate hundreds of billions, sometimes more than $1 trillion, of their citizens' money. Their time horizon is measured in decades. Their moves ripple across continents. And the way they invest is often more technical than people imagine. A large sovereign fund is usually built around strategic asset allocation. A long-term target mix of equities, bonds, real estate, infrastructure, private equity, sometimes more exotic sleeves. That mix is designed around objectives that are not purely beat the market. It might include inflation protection, currency diversification, liability matching, and liquidity planning. Then comes the daily work: rebalancing, risk budgeting, and governance. If equities rally hard, the equity weight can drift above target. A disciplined fund may sell some equities and buy bonds or alternatives to bring the portfolio back in line. That sounds boring, but it is powerful. It forces a kind of mechanical contrarian behavior. Trimming what ran up, adding to what fell, in a way that can stabilize the system. They also have to manage currency exposure. If you are a small country investing globally, your assets are in dollars, euros, yen, and more. Your future liabilities, like government spending, are in your local currency. That means currency risk can matter as much as stock picking. Some funds hedge parts of their currency exposure. Some leave it open as a diversifier. Either choice is a statement about what risks you want. They manage liquidity too. A sovereign fund might own private assets that cannot be sold quickly, plus public assets that can. The fund has to ensure it can meet obligations even in stress. That becomes a design problem. How much can be illiquid? How much must be liquid? How do you avoid being forced to sell at the worst time? This is where sovereign wealth funds start to resemble the quiet architects of the global system. They are not shouting on TV. They are moving through memos and mandates. But when they tilt toward infrastructure, capital follows. When they decide climate risk must be priced, whole sectors reprice. When they co-invest with private equity giants, they help set the terms of what private markets become. They are, in a literal sense, the money behind the money. Sovereign funds also blur lines in a way that makes people uneasy and sometimes hopeful. They are public in ownership, but often opaque in operation. They can pursue pure return, but they can also pursue strategic goals: domestic developments, technology transfer, geopolitical positioning, resilience of supply chains. That can be controversial, but it also reflects a reality most people feel. Economies are not just markets, they are national projects. A single sovereign fund might own stakes in global blue chip companies, apartments in major cities, ports and airports, fiber networks, renewable energy projects, and venture capital funds backing new technologies. It might be a silent shareholder in your index fund without you knowing. This is part of the modern paradox. Ownership has gone global, but our intuition about power is still local. We see the shop on our street. We don't see the fund 2 layers up. We see the apartment building. We don't see the vehicle that owns it. The money is abstracted, layered, securitized, wrapped. And yet, this abstraction can also be a kind of resilience. Capital can be diversified, risks can be spread, countries can save for the future, infrastructure can be funded without waiting for a single government budget line. The same machinery that can feel distant can also make long-term projects possible. Now, zoom again. Not to a tower, but to a small bedroom or a kitchen table. A 20-something scrolls on a phone. A notification pops up. Stock surging. Trending. New high. Earnings tonight. With a thumbprint, this person can buy a slice of almost any public company, an ETF, an option, a fraction of a coin. No broker on the phone, no paper form, no minimum account size that makes you feel excluded. Just taps. This is the third phase of modern capital: retail participation at scale. The pandemic period made this visible, but the trend started earlier. Commission-free trading, fractional shares, and slick interfaces collapsed barriers. Social media turned investing into a public conversation, sometimes thoughtful, sometimes ridiculous, and often both in the same thread. And again, there is a technical machinery underneath the cultural moment. Retail trading is routed through brokers, market makers, and exchanges. Orders can be internalized, matched off exchange, or sent to public order books. Some of this is about best execution, some about economics. Payment for order flow, bid-ask spreads, rebates, routing rules, all shape what free trading really means. options add another layer. When a crowd piles into call options, market makers who sell those calls often hedge by buying the underlying stock. That hedging flow can push the stock up, which can trigger more call buying, which can trigger more hedging. In extreme cases, this feedback loop can create violent squeezes that look like collective magic and are, in part, mechanical hedging dynamics. During the meme stock episodes, headlines said, "The little guy versus Wall Street." The truth was stranger. The little guy mattered, but so did the market's plumbing. So did short interest, borrow availability, margin rules, and the fact that settlement takes time and requires collateral. If you want a clean moral, you won't find it. But if you want a lesson, it's this. Modern markets are social and technical at the same time. Narratives move people. Plumbing translates these movements into price. Put these scenes together. Cathie Wood's public conviction, sovereign wealth funds' slow gravity, retail traders swarming energy, and you can see what has happened to capital in the last 2 decades. It has acquired new faces and new speeds. Attention itself has become a kind of capital. When a manager makes a compelling case for a theme, flows follow. When a sovereign fund shifts its mandate, capital pivots. When a stock trends, liquidity appears, then vanishes, then reappears somewhere else. Underneath, the old structures still matter. Central banks set base conditions. Index giants translate savings into broad exposure. Private equity and private credit funds finance companies and assets away from public view. Quants and market makers keep the pipes flowing. But the surface is more crowded now. More voices, more narratives, more people who can truthfully say, "I helped move this." That sounds chaotic, but it also contains something optimistic. Because more participation means more scrutiny. More voices means fewer monopolies on interpretation. More access means that the ability to invest and build wealth is not limited to people with inherited connections. Democratization of access is not the same as democratization of control. That is true. But access still matters. It changes expectations. It changes what institutions must offer. It shifts the cultural default from markets are for them to markets are also for us. And once expectations change, systems adapt. Another shift is happening, quieter than the memes, but deeper. For decades, portfolios were built around asset classes and geographies. US stocks, European bonds, emerging markets, the language was map-like. Now many allocators talk in themes: climate transition, aging populations, digital infrastructure, AI and automation, resilience, security of supply chains, health innovation. Sometimes this is marketing, sometimes it is a real pattern recognition. A sovereign wealth fund in a resource economy cannot treat climate as a moral accessory. It is a core risk and a core opportunity. A manager focused on genomics cannot treat biology as a sector. It is a platform technology. A retail investor learning about AI is not just picking a stock. They are trying to understand the force shaping their work and their world. Capital is starting to follow narratives more explicitly. Not only what is cheap, but what world is coming. This can create bubbles. It can also fund breakthroughs. If you want a slightly hopeful read on the era, it is this. The same machinery that can overshoot and hype can also mobilize resources fast. When the story is right and the technology is real, money can build factories, scale manufacturing, accelerate research, and roll out infrastructure. Finance, at its best, is a coordination tool. It lets many people pool belief into real-world capacity. The trick is learning to tell the difference between belief that builds something durable and belief that is just heat. So, where does that leave us at the end of this season? We began with families and banks, with information moving faster than armies, and we followed the plumbing forward through crisis, innovations, new instruments, and new kinds of power. We watched finance become more institutional, then more automated, then more distributed. And we end here, in a world where capital has more faces, more channels, and more narrative forces than at any time in history. From sovereign halls to group chats, from glass towers to kitchen tables. If there is a single practical takeaway, it is not that one group has replaced another, or that the old system has been overthrown. It is that the system has become layered. Visibility sits on top of machinery. Stories sit on top of flows. Apps sit on top of rails. A ticker on a phone sits on top of market makers, clearinghouses, margin rules, and settlement schedules. A sovereign allocation memo sits on top of risk budgets, currency hedges, and liquidity design. And a thematic fund sits on top of a very old question. How much of the future are you buying, and what happens when the price of time changes? That sounds abstract until you realize it is personal. These forces shape the cost of borrowing, the availability of mortgages, the funding of new technologies, the resilience of pensions, the speed of recoveries, and sometimes the severity of downturns. They influence which projects get built, which companies get oxygen, and which ideas move from prototype to infrastructure. There is also a more optimistic reading of all this complexity. More participation means more scrutiny. More channels mean fewer monopolies on interpretation. Better tools mean more people can learn, compare, and demand clarity about fees, risks, and incentives. The system will always be imperfect, but it will always overshoot sometimes, because humans and crowds are part of it. But it can improve. It can become more transparent. It can become more resilient. And it can fund genuinely useful things when incentives and governance are aligned. In the end, the new priests are not just individuals on TV or committees in quiet buildings. They are the decision frameworks themselves. The rules of allocation, the constraints, the risk budgets, the narratives that attract flows, and the plumbing that turns those flows into price and power. If you understand even a little of that machinery, you're harder to mislead, less surprised by volatility, and better able to choose where you place your own trust.